Solana. Oh my God, look at that. Let's go back to ETH. So this Solana chart is this period in ETH. Is what we're seeing in Solana now. So it kind of did the wedge pattern. Again, depending how you draw it, nothing's ever perfect. If this is a flat top wedge pattern, and somewhere around here, it finds its base, hooks up, and then it will have the power to break through, and we can have a serious move, the move we've been expecting.
Raoul Pal, co-founder and CEO of Real Vision and global macro investor, shared his latest insights on the cryptocurrency market. He focused on the major altcoins and the overall liquidity environment that could fuel the next big rally. According to Paul, the cryptocurrency market is gearing up for a turning point, but many segments of the ecosystem remain in a holding pattern. Bitcoin and Ethereum have already set the tone, while other cryptocurrencies are still waiting for a resurgence. He indicated that the Total 3 index, which excludes Bitcoin and Ethereum, is ready to break out of this holding pattern, meaning the altcoin market as a whole could be next. You have to be patient. The path is clear, but you should never expect absolute perfection. What counts is the trend. Paul shared a recent chart of Ethereum and described its current phase as full port. The chart shows Ethereum emerging from a long consolidation phase that began in 2021, with increasingly higher lows regularly encountering resistance. Regarding Solana, Paul indicated that this cryptocurrency is the next to exit the waiting phase. According to Raoul Pal, Solana is about to repeat what Ethereum did in the last cycle. Before we move forward, if you want to stay updated with the latest crypto events and news, you can subscribe to our channel and like this video. Now, let's get back to Raoul Pal's view on Solana and the overall crypto market.
Seasonality. We're at a really good point in the seasonality chart. And you would imagine that we are now diverging from this because of the, repeat after me, the Treasury General Account and the government shutdown. Once that comes back in, we start climbing the curve to the end of the year. Does it start in November and we play catch up? Either way, we should have a back end of the year that's very strong. And in the end, you'll have forgotten all about it. Much like we told you in April 2024, September 24, April 25. Russell 2000, think of Russell 2000 as, remember I mentioned it before, a reflection of the business cycle and highly correlated to alts. Alts, Russell 2000, you are around this level here. And you generally have a bit of weakness. November, up only into the end of the year. That is so common that I remember hedge funds trading this back when I was back in NatWest. So we're talking 95, 94. There was a hedge fund, Everest Capital, based out of Florida. Every year, trader would come on and quote huge size, these call spreads where he sold puts in the indices, because in the last couple of months of the year, because he figured out this pattern. Most people weren't really looking at it, and it worked.
Raoul Pal firmly refutes warnings about a tech or cryptocurrency bubble. He argues that we are staying within normal trends. According to him, price to earnings, PE, analyzes obscure how asset depreciation inflates prices. He also points out that Bitcoin moves along its trends without reaching extreme highs. He links all of this to global liquidity and debt cycles. His perspective presents current prices not as irrational, but as determined by precise mechanisms. Paul asserts that we cannot speak of a bubble in the markets as long as tech and cryptocurrency stocks remain within one standard deviation of their long-term trend. He contrasts this with the late 1990s when valuations soared well above the trend. He argues that the discourse surrounding bubble valuations ignores how weakening fiat currencies cause prices to rise faster than earnings. Furthermore, he also highlights Bitcoin's position relative to the trend. He indicates that Bitcoin is currently less than one standard deviation away from its long-term channel. He predicts that historically, it generally reaches two standard deviations, implying significant upside potential. After political hurdles, bureaucratic delays, and government gridlock, Solana Cash ETFs have finally been approved and are now trading. The Bitwise Solana Staking ETF launched on New York Stock Exchange, ARCA, after the exchange certified its 8A documents. Remarkably, BSOL achieved the highest trading volume of any ETF launched this year, reaching 56 million and surpassing XPRR, SSK, and BMNU. Following Bitwise, New York Stock Exchange, ARCA, also approved the listing and registration of the Grayscale Solana Trust ETF, GSOL. Canary's Marinade Solana ETF is poised to follow suit. With the cash launch of Solana ETFs, analysts are revising their predictions for Solana's price and raising their year-end targets, with the current consensus at $400. Meanwhile, demand for Solana derivative cryptocurrencies, meme cryptos, is surging, particularly among sophisticated investors who view them as bets on Solana's beta. The approval of Solana spot ETFs represents a major milestone for the broader cryptocurrency market, especially considering the key role Bitcoin and Ethereum ETFs played in fueling their respective rallies earlier this year. Bitwise Asset Management's BSOL ETF aims to invest 100% of its assets in staking, giving investor price exposure and staking rewards within a regulated framework. This could curb sporadic selling pressure on Solana. JP Morgan analysts estimate that Solana ETFs could attract $3 billion to $6 billion in capital inflows over the next 12 months, an amount that would represent a significant portion of Solana's total market capitalization. Paul predicts that Bitcoin will peak in mid-2026, arguing that the cryptocurrency now follows broader macroeconomic cycles rather than the strict 4-year halving schedule. He bases his analysis on the persistent weakness of the ISM index and the rising maturities of U.S. Treasury bonds, which have slowed cash turnover and the expansion of risk assets. Paul highlights the ISM index of U.S. manufacturing activity as the primary macroeconomic indicator. The ISM has remained below 50 for most of the past 3 years, indicating contraction. This prolonged weakness has curtailed sustained gains in risk assets, delaying Bitcoin's usual post-halving expansion. If Paul's thesis holds true, investors should expect a more robust rally in the first half of 2026, with a likely peak in the second quarter of that year. Brief upticks could occur before that date, but sustained expansion depends on the recovery of macroeconomic indicators. Paul believes the cryptocurrency cycle is not nearing its peak, but is entering a longer, more powerful expansion phase that could extend into 2026, driven by increased global liquidity linked to sovereign debt dynamics. Cryptocurrencies and the technology remain the only asset classes structurally capable of overcoming what he calls the hidden depreciation of fiat currencies. Liquidity is the key to cryptocurrency success. The most important macroeconomic variable of all time, Paul stated, is the increase in liquidity by governments and central banks around the world to manage debt at a rate of 8% per year. He distinguished this ongoing depreciation from measured inflation, advising investors to think in terms of minimum required rates of return, not headlines. Every investment has a minimum rate of return of 11%. If your investments don't reach 11%, you get poorer.